Good morning, everyone, and thank you very much for joining. This is the morning market review. It's Wednesday, it's the 28th December. My name is Russell Shaw, Senior Market Specialist at FXCM, and my email address is rshaw@fxcm.com. Can I just double check? Can you guys see the screen? Can you hear me? And can you see me on the camera? Just want to double check that. Just want to double check. Can you guys hear me, see me, and see the screen? Let me just check the sharing here. Okay, cool. Thanks, Anna. All right, we're going to have a short one today, but I thought I'd show you something which I find quite interesting. Just before we get into that, here's our market commentaries disclaimer. I want to just keep this up. We won't do a crypto today, but what I want to show you, I think, is very interesting. And I'll just bring up our references: MarketScope 2.0, tradingview.com. All right, so I'm going to just bring up this chart. This is Caterpillar, and what I want to show you is this is a weekly chart, and the indicators below, we've got a 52-week rate of change, and we've got a stochastic, and I've actually got the overbought, big one. Let's not call it overbought. I've got the extreme levels at 70 and 30. Stochastics don't have overbought, don't have oversold. You guys know my sort of explanation on that. But what I want to show you is this type of analysis is really useful, especially when you've got a list of companies. So if we go through to a relative strength chart here, we'll come back to Caterpillar in a moment. So if I just go US 30 divided by the NASDAQ 100, so we're doing a relative strength here. And what you can see when I bring this up is that the Dow Jones is really outperforming the growth companies at the moment. And the reason that the Dow Jones companies are outperforming is because they are value companies, they are more established companies, they pay dividends, they're the safer option at the moment. And because they're the safer option, money has been moving into the Dow, rotating out of the riskier growth side of the market, and effectively that's why you can see that the Dow Jones has really outperformed. Now, what you can do is when you're looking at the Dow, you've got 30 companies in the Dow, right? And let's say you want to choose the top 10 performers, and then you want to consider them for a portfolio. So this would be a longer term analysis. We're looking at the weekly. So what you can do is, if I have to bring up CAT again, okay, now it's much easier actually to do this on an automated platform. Otherwise, you're going to have to eyeball through all 30 companies. And what you're actually doing is you're looking for the rate of change, the company with the highest rate of change. So you'll have 30 companies in your list. You'll just put rate of change next to all of them, and then you'll rank them, and you'll see which are the top 10 of the 30. We're not going to do that. We're just going to look at 3 companies. We're going to look at CAT, we're going to look at Coca-Cola, and then we're actually going to look at Tesla, which is it's not a part of it's part of the S&P. Not part of the Dow. So the idea here is you can see that we've got 17%. So on a 52-week basis, Caterpillar is up 17%. Now, what you can do is let's take a look at this in terms of CAT versus, I'm just going to bring up, let's look at let's look at, which is a good company. Let's look up General Electric. So General Electric over a 52-week basis is down 12%. Okay, so over 52 weeks, we've got General Electric, which is down 12. This is still a good-looking chart, by the way. I would be interested in GE, but let's not discuss that today. All we're looking at is the rate of change. Let's go back to CAT. So CAT's obviously the better performer over 52 weeks. What about its current momentum? Well, its current momentum is it's in the area of strength, isn't it? It's above 70, and as long as it holds above 70, well, you can see this is a really good looking chart at the moment, and you can just follow the momentum. Take a look over here when it sort of breaks the 70 and then comes down. So there's a nice trending move here. Okay, we're just looking at stochastic here, notwithstanding the rate of change. So you want to arrange in some sort of ordinal fashion the 30 companies, say in the Dow. I'm just using this as an education example, please. I'm not giving you advice. I'm just saying, if in South Africa we've got the top 40, so I'd get the top 40 companies and I'd arrange the top 40s and trying to see which is the strongest, and then I'd look at the current momentum. And we're looking at a longer term portfolio here, right? Take a look at Coca-Cola here. And you can see that over the last 52 weeks, Coca-Cola is actually up 8%, which is really good over the last 52 weeks. The last 52 weeks has been pretty poor. I think we would all agree with that. Don't worry so much about the slope or the shape of the rate of change. You want to look at the value of the rate of change, and you want to use that as an ordinal filter. You want to kind of see where are they in the 30 companies. Are they in the top 10? Are they in the top 5? Are they in the top 3? You know, you might, and then you want to see, well, what's the current stochastic? What's the current momentum? And you can see that Coca-Cola is actually looking pretty strong. In terms of classical charting, this is a V reversal. This is a very strong V reversal. So now we've actually looked at 3 companies because we included General Electric, but Caterpillar is looking pretty strong. What do you mean by longer term? Yeah, well, so what you would do here, Anna, is that you would be monitoring this on a week-by-week basis because you are looking at a weekly chart. Effectively, if your stochastic falls below 70, right, well then the momentum is dying. But if you go back to this movement here, I mean, it started in May and it ended in September. So we had June, July, August. So we had about 4 months worth of trade there, right? But if you go back to, say, Caterpillar, okay, you go back to Caterpillar, well, over here, it started in June 2020 and it ended in June 21. So here's a year's worth of price movement. So so when we're looking longer term, we are looking up to anywhere from, say, sort of a quarter, say 3 months, onto a yearly basis. And what you can actually do is you can actually go up to a monthly. And what you can do on a monthly is you'll just adjust this, instead of 52 weeks, you'll use 12 months to get your reading. So you're getting a 12-month reading. And then what you'll do is you'll use your monthly stochastic. So you'll have a longer movement here. So here, this movement here starts in September 2016. It goes all the way to June 2018. So that's a gigantic movement here in Caterpillar. So you can see that depending on your time frames here, we're no longer talking about day trading. We're not talking about scalping. We're not even talking about swing trading. We're talking about really portfolio type positions here. The next, just let me know, Anna, by the way, if that answered your question. I think I've answered it, but the point is you're looking anywhere, let's say from 4 to 12 months and beyond, depending on the settings. All right, let's just go through to Tesla. So we've looked at ways that you can potentially go and filter out long positions. Well, you can actually use this to filter out short positions. So we've actually got Tesla, which is down 70% for the year. Over the last 12 months, Tesla's down 70%. Can you guys believe that? Now, take a look at the chart pattern, head and shoulders. Okay. But from really being a golden child, so to speak, we're down 70%. But if you wanted to build up a short portfolio, what you can do is you can take a look at, say, the top 30. Let's just say we're looking at the Dow, or even if you're looking at the S&P 500, you look up the 500 and you take the 10 bottom. What I mean the 10 bottom, the 10 worst performers by their rate of change. Then you take a look at what's their momentum currently. And if their momentum's dropped below 30, well, you can just see the damage that's been done to the share price here. Typically, the momentum on the downside momentum on a growth company is going to be far faster than on the upside. And it's just because fear is a much stronger emotion than greed. So you can see, and you can actually do all sorts of weird and wonderful things with this. You can have what's called a market neutral portfolio. Let's say you've got enough capital for 20 positions, let's just say for 20 positions. You could go 10 positions in the top 10 long, the top strongest, and you can go 10 short positions in the 10 weakest companies. So then you've got 10 strong, 10 weak, and you've almost got a neutral position there. That's a lot of hedge funds actually do that. So this is a way that you can start playing around and using these to filter your positions. All right. With that all said and done, I think it's time for us to conclude. If there's any questions, please go ahead and type those in. This is something that we don't usually. Yeah, just go ahead, Anna. I'll wait for the question. So this is something that I use in portfolio management, but we've hardly touched it because we usually look at swing trading. We usually look at sort of shorter term positions. But to be quite honest, to me, this is a really good approach to the market. What is an automated platform? So automated platforms, I think there's different degrees of automated platform. How extreme do you want the platform to be in terms of automation? So what you can do is you can type in algorithms, okay? So what you can do is you can type in algorithms. So you have to know certain coding. Then you have to be comfortable with the coding on a platform. So I use a certain platform. I don't think it's appropriate for me to mention it. Yeah, I have used it previously, but it allows for coding, and it's got an API, which means that it can enter long and short positions. It takes all the emotion out of trading because everything goes according to the coding. But what happens if your code's wrong? Well, then you're in big trouble. Okay, so the idea here is you can run just a simple rate of change, an automatic rate of change, and it will list the company's rate of change, and then you can sort it from ascending or descending. So instead of going through 30 companies on the Dow, you can do something in a matter of seconds that would otherwise take about an hour to do. So it's automated. And then you can make, instead of then using automated decisions, you can actually try and make, you can try and think through your decisions. But then there is that emotional element that comes into it. Again, Anna, just let me know if that is something that has answered your question. How much do you need enough for 10 positions? So I would say that you need to have a fairly sizable bankroll there. Yeah, not for someone who can't code. That's right, but you can actually find people that can code for you, by the way. And we've actually got a coding partner for FXCM, which the coding is actually in plain English, which makes it much easier. I can give you some more information about that. I haven't used it personally, but if you want more information, I can certainly give you some information around that. How much do you need for 10 positions? So I would suggest that you need a sizable bankroll. Okay, so what you would do is, let's just say you had $100,000, you would put $10,000 into each position. If you had $50,000, you would put $5,000 into each position. So to be frank and sort of honest and transparent, the more that you have, the better it is in terms of your reward to risk ratio management. Does that answer your question as well, Anna? By the way, your question for someone that cannot code is very important. That's a very good statement. Again, I want to stress we have partnered with a company that you can code in plain English, and I can give you more information on that. Just send me an email. All right, any other questions? All right, to be honest, we're probably not going to go too much in depth in this type of a system because it's different. It's a different type of system. It's for portfolio management, but it's extremely potent. It's extremely powerful. I thought, well, you know, we're in the quiet period. There's not much happening in the markets. Let me discuss this with you guys. All right, there's no questions coming in, so I'm going to conclude at this point, and I shall speak with you tomorrow. Thank you very much, guys.